This is Alan Bush with the Financial Futures Forecast for Tuesday, June 2nd. Starting out with the stock index futures, we did see some pressure in the overnight trade. However, we have seen now some recovery, ironically due to the two economic reports that we have seen since the opening. Both of these reports coming in weaker than expected, including factory orders showing a larger than expected decline. The bullish aspects of this apparently is related to how these weaker reports might affect Fed policy. So anytime we do see weaker than expected economic numbers, it is likely to influence the Fed to delay a rate increase. And I think that is exactly what has happened today, with futures now well off of the earlier lows. And I would not be surprised to see a move to higher on the day in stock index futures. Also, longer term, still looks like the main trend is higher. Nothing has changed there. Now, over in the currencies, a lot of fireworks developing. Apparently, there is a better tone to the situation between Greece and its Eurozone creditors. Greece has submitted a new plan that is causing some optimism as far as possibility of some type of settlement before the June 5th payment that Greece has to make to the IMF. Greece has said that now that they will be able to make that payment, so that is causing flight to quality longs to be liquidated in the dollar index. So the dollar sharply lower today. European currencies, especially the euro currency, sharply higher with a better tone to the Greek debt situation. Also, we are seeing good gains in the British pound, this after mortgage approvals in the UK showing a very substantial increase. Higher energy prices supporting the Canadian dollar and the Australian dollar. Also, there is additional strength coming into the Australian dollar after the Reserve Bank of Australia kept interest rate policies unchanged, but more importantly, did not give any guidance as to when they may lower interest rates further. So that was the key that took the Australian dollar sharply higher. Now, over in the interest rate markets, we are seeing the front end holding up relatively well. It is a little bit lower, but the long end under some pressure again, as flight to quality longs are being liquidated in light of a better tone to the Greek IMF situation. So that is adversely affecting the long end. Also, we are seeing commodity prices rebounding over the last couple of months, causing some traders to think that there could be some global inflation lurking somewhere down the road, although it's very minimal at this point. But the fact that commodity prices, industrial commodity prices, have firmed is a negative for the long end. So we are now focusing on the short end of the curve, on our belief that the Fed will be forced to delay a rate increase. So any positions I think taken in the interest rate markets on the long side should be more at the short end of the curve, while the back end is likely to underperform. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.